Guys, nothing can stop it. The Fed has screwed up and they have printed too much money. And the consequences is we are heading towards a recession. Before we get into this, make sure you like, comment, subscribe. You're on the road to 200 subscribers. The value I bring to you is financial updates, housing market updates, any type of update. Goldman Sachs says the odds of a recession is 35% in the next 2 years. The problem is that number keeps rising. I saw some numbers saying it was predicted to be 18% last January. Now it's shot up to 35%. Now that can be pretty worrying. While also knowing that the Fed's meetings have been pretty frequent. And just this month, the Fed has raised the federal funds rate up to 0.5 basis point. And just a couple months prior to this, in March, they raised it for the first time since 2019. This then caused mortgage rates to go up to 6%. And not to mention, this is historically average, but guys, we have 8.5% inflation. And granted, this is an estimate. It could be in the double digits for all we know. People are making 8.5% less than they was pre-pandemic. Okay, guys, let's say you was trying to buy a home and the median sales price of a home is $428,000 as of right now. So I put the loan amount. So let's say your down payment is 20%. So your loan amount is $342,400 because you only putting 20% down. And interest rate as of right now is 6.241%, and you're on a 30-year fix. And let's include taxes and fees. So you have property tax and you have home insurance. So your total monthly payment would be $2,677. I don't know if this is even including inflation, but let's look at it. Let's say when interest rates was kind of low, let's say 3%. Let's go with 3%. Include taxes and fees. You're around at 2015 basically. So guys, this is a 25% increase. And the reason why I'm so avid that a housing crash will happen is because that is usually the goal when the Fed does stuff like this. When they raise interest rates, trying to raise it pretty high, like let's look at 1981, 1982, Paul Volcker, in the midst of extreme hyperinflation to the point where he had to raise the interest rates super high and they entered a recession. And a lot of people didn't like it for that. But now that seems to be the thing we're in. Probably not as bad as it once was, but we still have to, the Fed still has to take action. I mentioned this also in my latter videos that, and nobody seems to be talking about this, is some of these banks are starting to lay off their employees. Wells Fargo laid off some of their employees because you know why? They see that the demand is going, less and less people are applying for a mortgage. Why? Because if it's 6%, it's no longer these low rates that people got so used to. People are not going to be wanting to buy a house like that. And as a business, there's no point of having too many workers because you also have to maximize your profits. Now let's look at this article by Redfin, which is honestly not surprising. According to Redfin, 12% of homes on its site saw sellers cut prices in the week ending April 9th. Housing market update. More sellers dropped their prices, but buyers find little relief. Home buying is as competitive and costly as ever as soaring mortgage rates make the market less inviting for many would-be sellers. The share of home sellers who dropped their asking price shot up to a 6-month high of 15% for the 4 weeks ending May 1st, up from 9% a year earlier. The 5.9% increase is the largest annual gain on record in Redfin's weekly housing data back through 2015. Well, you kind of may think the article kind of goes against what I'm saying, but I relate this to a train. You stop the train, it doesn't immediately stop. The train keeps going for a while and then it stops. Mind you, mortgage rates went up, but it's still going to take a good amount of time for it to affect the housing market. And not to mention that home builders are building more than ever. I always says this, like a lot of building permits are being sent out. Leading indicators of home buying activity. Fewer people search for homes for sale on Google. Searches during the week ending April 30th were down 7% from a year earlier. The seasonally adjusted Redfin Home Buyer Demand Index, a measure of requests for home tours and other home buying services from Redfin agents, was down 1% year over year during the week ending May 1st. It dropped 10% in the past 4 weeks compared with a 1% decrease during the same period a year earlier. Towing activity from the first week of January through May 1st was 24 points behind the same period in 2021, according to home tour technology company showing time. Mortgage purchase applications were down 11% from a year earlier, while the seasonally adjusted index increased 4% week over week during the week ending April 29th. Let's go to another housing market data source, CoreLogic, and they kind of support my analogy that I just kind of said. Economic impact on home prices. U.S. home prices continue to post significant year-over-year gains in March, up by 20.9%, another record high. Even with the past year's streaks of double-digit prices increases, annual gains are projected to slow around 6% by next March, due in part to rising mortgage rates and higher home prices, hampering affordability for some home shoppers. Buyers who closed on a property in March had a good chance of locking in mortgage rates around 4% or slightly lower. By late April, rates had moved up to more than 5%, a jump about 30% from the same time last year, and a trend that might derail more buyers. See guys, one thing I learned about studying economics: if you're going to price something expensive, the market determines the value. So if you put a house up for these ridiculous prices and everything is going up, you can only put it so far until the main base can't afford it no more. So you have to go down. How else are you going to stay profitable if nobody else buying your stuff? Well, this is going to be the end of the video. I typically don't make videos of this structure, but that's why it's kind of shorter than usual. But make sure you like, comment, subscribe. I'm out.